In the last session, viewers, you have understood what is derivative market, what is the meaning of derivative and derivative characteristics. You also have learned that in the derivative market, which are regulated, there are many participants like hedgers, speculators, and arbitrators. You also have learned that there are four basic type of derivatives: forwards, futures, options, and swaps. You already have learned about futures and forwards. Now you will learn what are the third type of derivative, that is options. As you can understand by the word option that you have many type of options. This is very complicated type of derivative, and this has more flexibility in terms of risk management. An option is a right to buy or sell an underlying assets at an specified exercise price on or before a specified date. This is right to buy or right to sell. Underlying assets means shares, bonds, debentures, stock indices, currencies, and even commodities. But options are not free. You have to pay some price for buying or selling the options, and that is premium, which is paid by the buyer to the seller or the writer of the contract. Premium, as the seller is obligated to perform the contract. Premium is paid for the consideration that the seller will have to honor the contract. The buyer's loss is limited to the amount of premium because the buyer has the right to buy or sell, but this is not obligatory. But the potential profit of the buyer is unlimited. That is why options are very important. Options may be of two types. Number one is call option. Call option means it is an option to buy an asset. It is not the option to sell an asset. It is an option to buy an asset. It gives the option buyer the right to buy agreed number of shares at the exercise price of, or it is strike price on or before the maturity or expiry date. The buyer or holder has right to exercise. The contract is to be exercised by buyer or holder. He has the right but not the obligation. If on maturity the spot prices, the current prices of the shares are higher than the strike price, buyer will exercise his option to buy at lesser rate or exercise price. He can then sell it at the spot price and get the profit. The spot price is lower than strike price, the buyer can abandon the option. He has the right to let the exercise of the contract. In this case, his maximum loss will be the premium amount which he paid to the option seller. For example, a call is bought for rupees 10 with an strike price of rupees 100. If at maturity, if the spot price is below rupees 100, the buyer will not exercise the call option, as he may buy the shares below strike price in the open market. But if the buyer will benefit when the spot price is equal to or more than strike price plus premium, or say in this case the strike price is 100 and the premium is 10, If the share current prices of the share is more than 110, the buyer will be benefited. For option writer, the spot price is higher than 110 will incur net loss. He will gain when spot price is lesser than rupees 100. If spot prices is rupees 90, his gain will be 100 minus 90, 10 plus premium, or say rupees 20. You can see this example and understand it through the graphic presentation. Buying call option, you can see in the diagram that the premium is the cost of the buyer, but he will be benefited when share prices, the current share prices will increase, and he will get the potential profit. On the other hand, the writer of the call option will get the premium as his profit, but he will be benefited only when the share prices are increased. Put option. A put option is an put option to sell an asset. It gives the opinion buyer or option buyer the right to sell agreed number of shares at the exercise price or strike price on or before the maturity or expiry date. You can recall that the call option is an option to buy an asset, whereas the put option is to sell an asset. It gives the option buyer the right to sell at agreed number of shares at the exercise price or strike price or before the maturity or expiry date. The buyer or holder has right to exercise the contract but not the obligation. This is the benefit of this put option. If on maturity the spot prices are below the strike price, buyer will exercise his option to sell at higher rate, exercise price. If spot prices is higher than the strike price, the buyer can abandon the put option. He will let his exercise of the contract. In this case, his maximum loss will be the premium which he paid to the option seller. On the other hand, the option seller or writer has to honor the contract if buyer exercises his right. He received the premium as consideration if at maturity, if the spot prices is below the strike price, he will have to buy the shares from the buyer at higher strike price. So his potential loss will be strike price minus premium. You can see it in this diagram. See, a put option is bought for rupees 100 with an extra strike price of rupees 100. If at maturity the spot price is greater than 100, the buyer will not exercise the put option. When price is greater than 100, as he may sell the shares at prevailing higher spot prices in the open market. The buyer will benefit only if spot prices is equal to or below strike price plus premium. Say, you know that 100 is the strike price and 10 is the premium. So, at 110 or below, the buyer will be benefited. For option writer, the spot price below rupees 90 will incur net loss. He will gain when spot prices is higher than rupees 90. If spot prices is rupees 110, his gain will be 10 rupees, 110 minus 100 plus premium, or say rupees 20. Now swaps. Swaps are agreements between two or more people or parties on the basis of matching, or more simply on the lines, I will pay for you if you will pay for me. It means You can have a contract, you can enter into a contract with somebody who will say, I will pay for you if you are agreed to pay for me, like interest rate swaps, which refers to exchange of one set of interest for another set of interest. For example, you can enter into a contract with a bank. When they expect interest rate going up, they enter into a swap in which they would receive interest rates at floating rate. When you see the rates are contingent or possible to be increased, in that case you may enter into a contract with the bank that you will receive the interest at floating rates, but you will pay the interest at fixed rate. So there are two sets of rates, floating rates and fixed rates. While expecting interest rate coming down on in future, they would choose swap to receive at fixed rate and pay at floating rate over a period of time. So this is the risk avoidance or hedging against risk exposure by swaps. In the same manner, there are currency swap, which are arrangements in which currencies are exchanged at a specified rate of exchange and specified periods. For example, if a firm has borrowed a dollar loan and wants to convert it in rupees loan, it can do a currency swap wherein it will receive the principal and interest in US dollar, which is international money, and pay the bank at the fixed rupees interest rate and also freeze its principal payment for entire tenure of loan. So this is currency swap. Now you have learned the four types of derivatives, four basic type of derivatives: forwards, futures, options and swaps. Now you can conclude that derivatives are very important for risk avoidance and shields you from anticipated loss and also give you the opportunity to be benefited by the change of prices in your direction, in your expected direction. But so the basic objective of derivative is to reduce and hedge risk amidst volatility and uncertainty. You can see that different types of securities prices are volatile and uncertain. So therefore you want to shield your loss. However, derivatives are also used to speculate about future prices to earn profits. Derivatives should be used professionally, and if it is not used professionally, it will lead to deep problems. Therefore, great care and caution must be taken while using these instruments. They must be used to reduce risk rather than to make money through profits. Uh, in this session, in the part B of this session, I have told you that the financial market have a hierarchical structure and derivative market is a subset of the financial and commodity market. You have also learned that what is the meaning and feature of derivatives. You also knew that various participants and their role in financial derivative. Different tools such as forward, futures, options, swaps, etc. We discussed these tools with appropriate examples which enabled us to understand their distinctive features and uses. Besides financial markets, there are commodity markets and derivatives which are very significant for the growth of the economy. So in the next lecture, we would be discussing the basics of commodity markets and derivatives. Thank you. Thank you very, very much.